All right. Yeah, you're welcome, guys. And so you're welcome to 2023. Okay, you're welcome to 2023. Particularly, we wanted to do this session today because we know that as the year begins, a lot of us are already looking at what is it going to look like for us this year. You know, a lot of people are on holidays today. We are also on holiday today, right? So for a lot of people, work begins tomorrow. So we wanted to be able to have this session with you guys so that you'll be able to begin to look into the new year and seeing what does it look like? What's the plan for next year? How are you going to win in the forex markets next year? You see, the forex market is a very real market, and is a market where you can make the kind of income that you want. If it's a full-time income you want, you know what that is. The forex market in the forex market, you can more than do that. You can more than achieve that. If you want to make $1,000 a month, you want to make $500 a month, you want to make $5,000 a month, all of that is possible. If you want to make much more than that, 10,000 and above, you can do it in the forex market. Okay, but how do you do it? Like in any business, forex is a business. Okay, it's a business that you plan for. It's a business that you have a systematic way of doing. All right, it's a business you have a systematic way of doing. Just like right now, as you're starting the year, if you have a job, you have a business, you're making plans. How am I going to be the best at my job this year? How am I going to be the best at my business this year? How am I going to increase my turnover by 50%, by 100%? This year, how am I going to move from $100,000 in sales to 150,000 to 200,000? How do maybe I want to buy a new car. Maybe I want to move into a new house. Maybe I want to achieve this or achieve that. You know, we have goals that we want to achieve for the new year, right? Some of us have set those goals already. Some of us are still setting those goals. Yes, right? So all of that is important. Just as all of that is important, what you want to achieve with your forex trading business is very, very important. You know, sometimes we discover, sometimes we'll find that the way people begin certain business, the entry barrier for certain businesses makes people think that business is different from other businesses. For example, if you're starting a business let's say you're starting a payment business, a business that has to do with payment processing. You know that business requires a big business plan, requires investors, requires a lot of things, right? Or maybe you want to start a new shop. You know, you're thinking about, I'm going to get this shop, I'm going to stock it with all the things I want to sell. I'm going to have to get maybe a website, a social media platform, all of those things. You're thinking about doing them as a business. But many times, because people can just fund an account, $50, $100, and start trading, they think that forex is different from other businesses. You see, but forex is not different. It's the same. It's business like other businesses. Just that in forex, you do not have to look for customers, which is very important. You don't have to drag customers, try to snatch customers from other people. You don't have to try to increase your market share in forex. You can just do that by yourself. You see, so but that doesn't mean that in the market you do not have to make plans. You do not have to plan and do a lot of other things that regular businesses do. Okay, so that's the reason for this class today. We want to be able to help you to make the right planning towards your trading journey, to achieve winning, to make profit, to at the end of this year you'll be like, okay, this is what forex has done for me, right? It could not, probably not at the end of the year, maybe after the first quarter, maybe after the first half, whatever, you will be able to say, this is the progress I've made because of forex. This is the progress forex has helped me to make, right? That's the purpose of this class, guys. That's the purpose of this class. So everything we're going to do in the market is going to be deliberate, very, very deliberate, okay? And it starts with planning. Okay, so let's get into the class. So we said developing a winning trading plan for 2023. Developing a winning trading plan for 2023. Okay. So what's a trading plan? A trading plan is an all-important tool, and very important tool for traders, and is a set of rules and guidelines you will follow to you follow, and this includes your trading goals. Okay, so please, if you are not, I will recommend that you're able to take little notes. Okay, at the end of this class, guys, at the end of this class, there is a spreadsheet I'm going to give us. There's a spreadsheet I'm going to drop in the group that will help us to understand certain things. A lot of the things we are going to go through here, there's a spreadsheet I'm going to give you that will help you to understand it practically. All right, so we're going to go through a lot of theoretical stuff. Then at the end of the class, you'll be able to have that spreadsheet. I'll go through a few of the things on the spreadsheet at the end of this class, so that you'll be able to see what's on that spreadsheet and how you can use it for your practice, you know, to have probably your own thing, how this whole plan, how it can work for you personally, and how that's what that spreadsheet is going to be about. Okay, so you're going to have to set your goals. I recommend you take some notes, right, so that you'll be able to go back and then be able to get all these things. So number one, you want to take some notes. You want to trade. You want to start with your trading goals. So what are my trading goals? What do I want to achieve today, this year? Now, in trading. So now, with goals is that you may, right now, the number one things goals do for you, especially when you make goals that you have not achieved before, is that goal helps you to grow. Okay, so let's say, what I mean by that is, let's say you never made $1,000 before in the market, and you decide I want to make $1,000 in the first quarter or in the first month. Remember, you can always increase that goal, right? Whatever it is, I want to make $1,000 by so and so time, okay? Or I want to make $5,000 by so and so time. If you've never made that money before in the market, the first thing, the most important thing right now that goal is going to do for you is going to expand your mind and stretch you, which means that you are going to have to improve. You're going to have to improve yourself. You're going to have to grow yourself. You're going to have to attend trainings. You're going to have to improve your skill in the market, okay? Now, even if you're taking signals and you're just, okay, this is my strategy at this time, I'll just pick the signals, I trade them. You need to know how to pick signals properly. You need to know how to manage those trades when those trades trigger. You need to know how to take care of risk management. All of those things are very, very important, but it starts by you setting goals. I'm trying to explain why goal is important. So whatever it is, I won't tell you this what goals to set, but decide. Just decide. Don't worry about how you are going to achieve it. Don't worry about, oh, I've never done this before. There's always the first time to do what you have not done before. Okay? Be bold. Set a goal. What financial goal do you want to achieve in trading this year? Set it, right? And write it down. Okay? Now, that goal, you can say, oh, I don't want to set a goal that's too small. I don't want to set a goal that's too big. Just pick a goal you know you'll be comfortable with. When you achieve that goal, you can always increase it. All right, just pick a goal. When you achieve it, you can always increase it. And if the goal is so big and you don't achieve it, if you achieve a fraction of it, that will give you confidence to even go for the bigger goal. So wherever, I'm just saying, wherever it falls in the spectrum, whether you think the goal you're setting is small, or you think the goal you're setting is too large, it doesn't matter, just set it, right? Okay. Number two, what contained in your trading plan is your strategy. What exactly am I going to do? How am I going, what strategy? Because in the market, we talk about strategies. We're like, okay, how do you, strategy is basically your approach to the market. That's what strategy is. So what do I have to see for me to enter the market? What do I have to see for me to exit the market? That's what your strategy is, okay? That's what your strategy is. So a trading plan contains your strategy. Okay, so a trading plan, later on, we're going to talk about more about strategy. We're going to see some examples of strategy and all that. So that's the second thing. But three is risk management. What is your risk management plan? These are the things that should be in your trading plan. Now, if you do not understand any of these, let's say you don't understand risk management properly, we have classes for risk management. But just know that that's part of it. And when you are going to build your trading plan, you will begin after this class, guys. I recommend you start to build your trading plan. That's actually going to be my assignment for this class. You build the trading plan and you send to me for review. Okay, and that's going to help you, not me. Actually, it's going to help you, not me. For those who decide that they don't want to send it, that's what I'm asking. You know, some people, we know that when we're out of school, it's hard. We don't want to do things that look like assignments and all that. But when it involves improving ourselves, I think it's important we do it. Okay. So whatever you do not understand here, we have classes for it, right? So just go with me on this. Number 3, you have risk management. That's part of your trading plan. What's my risk management? What can I, on a trade that I'm taking, what can I afford to lose? What can I afford to risk? Okay, that's what we think about first when we want to enter a trade. We think about, what do I stand to risk? What do I stand to lose on this trade? If this trade doesn't go where I expect it to go, what do I stand to lose on this trade? Right? 1 minute, guys. Okay, so what is it that I stand to lose if this trade doesn't go my way? We know that trades may not go your way 100% of the time, and you do not need trades to go 100%. You don't need 100% win rates to make profits. No, you don't need that. Okay, there are several things you need to be very profitable. So you don't need all your trades to win. You can have 50% win rate, which means that if you take 10 trades, 50% of them win, 50% of them lose. Yet you are in massive profit. Yet you are in massive profit. Okay, so there are ways to do that. All of that needs to be on the plan. So you've set your risk first and like, okay, it's recommended that if you're just starting, your risk should not be more than 3%. Your risk should not be more than 3%. So if you have $1,000 on a trade you are taking, you should be setting a framework that, okay, I will not risk more than 3% on my account, which is $30. How does that affect my stop loss, my take profit, especially my stop loss, my lot size? Okay, what's going to be my lot size for a certain amount of money? Let's say I have $1,000 in my account. What will I take? Let me take that $1,000 and break it into segments of $100 each. What's going to be my lot size for each $100 on that account, right? So if I use 0.01 on each $100 and I have $1,000, that means I'm using 0.1 to trade $1,000. Let me say that again. If I'm using 0.0, if I'm allocating 0.01 lot size to every $100 in my account, it means that if I have a $1,000 account, therefore I'll be using 0.1 to trade that $1,000. Okay, so that is what you want to look at. When it comes to risk management, you're talking 2 major things. Number 1, how much do I want to risk per trade? How much do I want to risk per trade? 3 things. How much you want to risk per trade? That's number 1, which could be a percent of about 3% or so. Then the next thing you're thinking about is what is going to be my lot size? What's going to be my lot size for the kind of account that I have? For the size of account that I have, what's going to be my lot size? Those are the 2 most important things you want to think about, because the third thing would be stop loss. Where is my stop loss for the trade I'm taking? Where's my stop loss going to be? But that is going to vary depending on the trade you're taking. That will vary depending on the trade you're taking. So that's why I said the most important things you have to consider, 2 most important things are your risk per trade, how much you're willing to risk per trade of the capital you have, of the margin. Your capital is called your margin. Of the margin that you have, how much of it are you willing to risk? That's number 1. You have that at the back of your mind. Then you now ask yourself, what's going to be my lot size for the capital that I have? Okay, Like I said, the third thing is stop loss, but then stop loss is adjustable because trades are different. You could have stop loss of 50 pips on one trade. You could have a stop loss of 30 pips on another trade. You could even have stop loss of 5 pips on another trade, depending on how you're on the conditions surrounding that trade, on how you are entering that trade, whether you are entering early or late or whatever, or the pair you are trading and all that. So that's for risk management. This is also meant to be in your trading plan. Then the next thing is trader psychology. So trader psychology is very, very important because it has to do with the state of your mind while trading, before trading, while trading, and after trading. Trader psychology before trading, while trading, during trading, and after trading. Because you have to understand that as a trader, whatever happens in the market has an effect on your mind. And whatever is happening in your mind, whatever is happening in the state of your mind at every time affects not the market, but the way you view the market and the actions you take in the market, right? The way you respond to the market is determined most times by your state of mind. That's why we call it psychology. It's basically about your mind. Are you in an emotional state of pain? Are you in an emotional state of joy? Are you in an emotional state of anger? All of those things play. Are you in an emotional state of fear? Or are you in an emotional state of greed? All those things play into your psychology. That's the state you are in. It plays into how you respond to the market, to the positions, to the setups that are happening in the market. So you want to be able to define ahead of time what's going to be my response to the market. Remember, let me give this as an example. When you enter a trade and that is a winning trade, it puts you in a certain state of mind. And that state of mind could be that of excitement. You just made quite some money now. That puts you in a state of mind. But do you know that that state of mind of excitement you are now could make you do something that could lead to losses? Because sometimes some traders make money and they think, okay, I'm confident. They become overconfident. The next trade, they now increase their lot size, and then that trade doesn't go well. They now discover that they've lost the profit that they just made and even some more. And then that now leaves you in a situation where you move from a state of excitement to a state of literally depression or anger, you see? And then when you feel angry, that's also going to color the way you look at the market, and that's also going to is going to affect the way you respond to the next trading opportunity that comes. So this is the reason why we have to define these things ahead of time and put it in the trading plan. Okay, when I feel bad, I'm not going to trade. When someone angers me, I'm not going to trade. When my wife or my husband gets me angry, I will stay away from the market. It's very important. That's how it is. Because you can enter a trade that you shouldn't enter just because you're angry. Yes, that's how it is. And the best way to handle this situation is to be aware. First of all, be self-aware. When you are aware, then of course you can take care of it. And that's why it has to be in the plan. In the plan. It shouldn't be something that is just in our minds, but it must be in the plan. Okay? So let's move on. Okay. So this is basically breaking down what it is that this is basically breaking down what it is that is contained in the trading plan. Define your goals. What do you have to achieve? What do you hope to achieve? We talked about this. What do you hope to achieve in the market? Do you want to generate a steady stream of income? Do you have a specific financial goal in mind? That's what I'm saying. Pick that goal. Clearly define your trading goals will help you to develop a plan that's tailored to your needs. All right, that's your trading goal. Then determine your risk tolerance. Looks like we've already gone through this. We've moved. So trading carries inherent risk, and it's important to have a good understanding of how much risk you are putting up for every trade. Okay, consider your financial resources and your personal risk tolerance when determining the amount of money. So that's what I said before. So you determine how much you're going to risk per trade, then that will now translate to your lot size Okay. Then of course, that works also with your stop loss for every trade, because for every trade, you're setting your stop loss, you're setting your take profit. Okay. So determine your risk tolerance. Trading carries inherent risk. We'll go to that. Choose a trading strategy. So there are several strategies in the market. There are several strategies, and we are going to be doing a lot of trainings around different strategies. Okay. Please mute yourself. Mute yourself. Thank you. Okay. So we're going to be doing a lot of training around different strategies. Okay. So but you're going to have to pick a strategy. You pick a strategy, and that strategy is what you are going to put into your plan. You put that strategy into your plan. You put that strategy into your plan, and then you are going to then use that plan. You're going to take that strategy that you have in your plan, and then that's what you are going to execute. Okay, that's what you're going to execute. Hold on, guys, 1 minute. Okay, so that's what you're going to execute. So you pick a strategy. There are many different strategies. There are strategies for scalping, there are strategies for range trading, there are strategies, all kinds of strategies. Consider your trading goals and risk tolerance when choosing a strategy. There are strategies we are going to be discussing. There are some we already use for our signals. There are those we are going to be training about. So when we are training, when we say, okay, we're talking about this strategy or the other strategy, you do well to be available in those classes so that you can learn these things, right? Of course, we have recordings for our classes, but then it's always best when you are in a class and you are able to learn and actually understand and actually ask questions. All right, you can ask questions, because if you watch a video, it may be difficult for you to come and ask questions later. But you know, when you are in the class live, it always gets you better, right? Okay, so when you get your strategy, you have to test them through a demo account. So these are some of the things we're going to do. Remember, in as much as you take strategy, you take signals, which is very important. You can use that to begin trading. We give signals every day. We still give signals today. We always give signals. We have signals every day. And even probably this week or so, very soon, we are going to start doing also live trading besides the signals we give. I personally will be sharing my trades as well on the platform so that we can take them along with the other signals that we give already, right? But even as we are doing all that, you have to understand that the biggest traders in the market, they have eyes to do market analysis themselves. So that's the reason for training. That's the reason we want to be able to set aside some time and join the trainings, right? So if you put in 1 to 2 hours every day and you're consistent, you will discover that you'll be able to improve yourself. As you improve yourself, the money you make you'll be able to increase whatever it is that you have in your goal. Okay, you can make some money from strategy, from signals, but by the time you start to learn markets by yourself, you discover you can increase your earning potentials. Okay, someone was listening to someone yesterday, and the person said, in this year, he says, do not chase perfection, chase consistency. Don't chase perfection, chase consistency. So what I'm saying is, if you have 2 hours every day and it's night, 2 hours, 1 hour, 30 minutes, whatever, and you decide that I'm going to spend time on the market to do 1 or 2 things, to learn 1 or 2 things, to practice 1 or 2 things, you are going to be able to improve yourself very significantly. And I am very available to assist anybody that wants to improve themselves. If you want to improve yourself, I am very available to help, to assist you in any way that you need assistance, right? So that's very important. Okay. Let's go. So set entry and exit points. Set entry and exit points. So now, all of these are meant to be in your trading plan. All of these are meant to be your trading plan. So how am I going to enter these trades? At the end of this class also, I'm going to be sharing the spreadsheet I'm going to be sharing is going to have some information around this, some very visual descriptions of what this is all about. Okay, so stick to the end of the class. You are going to, that spreadsheet is going to teach a lot of things, going to clarify a lot of things for you. right? So entry and exit points. Where am I going to enter my trades? What am I? We talk about strategy. Okay, my strategy tells me how to enter the trade, what I need to see in order to enter, what I need to see in order to buy, what I need to see in order to sell. That's what my strategy tells me. Okay, so now based on that, I need to know what my entry and exit point will be. Okay, if I see a breakout, do I need to see a pullback before I enter? If I see a breakout for a buy, do I need to see a pullback before I enter? Or if I see a breakout, do I just enter immediately? See, all of those things, they are very, very important because different instruments in the market behave differently. Different instruments behave differently because there are some instruments that you're trading. There's an instrument I trade, okay? That instrument, some months ago, that instrument, the way I will trade it is every time there's a breakout, there will be a retest. There will be a pullback before an entry. But what I discovered recently was that doesn't work the way it used to work again. But something else is working. Okay? So that's the reason why when you are following these instruments that you're trading, that's also one of the reasons as we go on, you will understand why picking the instrument that you want to trade is very important. Okay, because you're going to follow. There might be changes along the way, but because you are following that instrument and you're always trading it, you will know when something has changed and you will not be able to observe what else is working. Like I said, the way I used to trade it is not working the way I used to trade it. It still works, but it works occasionally. It still plays out like that, but occasionally, not all the time. Previously, like 3 months, 4 months ago, 5 months ago, when I see a certain breakout, I know that, okay, this is what this is going to do. I can almost set my pending orders and just go and sleep, right? But now it doesn't play out like that. I have to use another tool to now understand the market and say, okay, this is where this thing is going to get to. This is the pullback it's going to give me before it continues in the direction it's going. It doesn't work. It doesn't work as it used to work before. All of that is because of my following the asset, trading it, understanding it. So that helps me now to set my entry parameters and my exit parameters. So all that needs to be in the trading plan, like we said. All that needs to be in the trading plan. All right. So your trading plan needs to have all these things. Your trading plan needs to have all these things inside. Set entry and exit points. Okay. These are based on technical analysis, fundamental analysis, or a combination of both. This will tell you based on the strategy you've developed, the strategy you're trading, okay, whether you developed it or you were given, you got it, or whatever. Like I said, we're going to talk about, we're going to have trainings on strategy and all that. You know, based on all that, you'll be able to now determine your entry and exit points from the strategy that you are using, which could be technical, fundamental, a combination of that. And the truth is that every strategy should contain technical and fundamental, okay? Because you want to always keep your eyes on what the news is saying, okay? So now set stop loss and take profit orders. Okay, so we said before that you want to manage your risk properly. You want to manage your risk properly. But then for every risk, there is also a potential reward. Yes, when we enter the market, we consider the risks first. Okay, we want to be able to pick our lot size. Like I said earlier, we're going to pick our lot size properly. We're going to pick our lot size properly. Then we're going to determine, first of all, what is our risk per trade? What's my risk per trade? Okay, I'm going to risk 3% on the market on this trade, right? Okay, we determine that. Then we determine, okay, what's my lot size? So for every $100 on my account, I'm going to use 0.01 or I'm going to use 0.02. Okay, I have $1,000 in my account. I'm going to use 0.2 or 0.1 like that. So I said that, but then all of this is risk. All of this is risk. But what is my reward? What is my reward? Because every risk needs to come with a reward. That's what's usually called calculated risk taking. Calculated risk taking. Okay. So you want to be able to look at the reward and say, okay, this is the risk I'm willing to take in order to capture this reward. Okay. So you set your stop loss. Your stop loss is your risk. Is the risk you're taking. While your take profit is the reward of your trade. Your stop loss is the risk you're taking, while your take profit is the rewards that come from your trades. You see that now? So that's why you have to ensure that's in place. You can't set your stop loss and just leave take profit. You want to be able to know that, okay, I set a stop loss of 30 pips. Now I want my price to, when price goes positive goes in my favor to the tune of 30 pips, I want to take my profit, right? I want to take my profit. So all of that is very, very, very important. And it should be within your trading plan. Something else we're going to add later is what we call risk to reward ratio. Risk to reward ratio. What's going to be your risk to reward ratio? What that means is that for every risk you're taking, what's your potential reward? Is it commensurate? Is it the same amount of risk? Is the reward you're targeting, is it the commensurate with your risk? Is it larger than your risk, or is it smaller than your risk, or is it equal to your risk? Because ideally, your reward ought to be at least equal to your risk or greater than your risk. So if you're risking if you have $1,000 and you're deciding that I'm going to risk 3% of $30 on that trade, your reward should be at least $30 or more. Your reward on the trade, when you are risking $30, should be at least $30 or more. That's what we call risk to reward ratio. Okay, and then the way you determine that is by setting your stop loss and take profit. All right. Monitor and review your trades. Okay, this is where a lot of us want to shy away from knowing what's going on. Okay. Now, this when you're making profit, of course, it increases your balance. But that is just the superficial. That's the superficial results you are seeing there. But because when you want to learn, we usually hear that you don't learn from success as much as you learn from failure. Of course, you can still learn from success, from your own success. Oh, I did this and I did this well. Okay, I need to repeat more of that. But you learn a lot more from actually the mistakes that you made, right? Why? Because you know what you should not do next time in order to increase your success rates. Okay, so if you know what you're doing right that works, you put that down, right? Okay, now you look into the mistakes you made, and your goal is to minimize those mistakes so that you can increase your success rates. You want to minimize those mistakes so that you can increase your success rates. Okay, so how do you do that? Measure and review, monitor and review. Okay, what did I do wrong? Why did this trade lose? Why did I enter this trade and it lost? You want to be able to find out. First of all, you're going to have to document it. Like I said again, at the end of this class, there's a spreadsheet we're going to go to, and I'm going to share that spreadsheet too. We'll be able to understand more of this practically. Okay, how exactly you would do it, right? We'll see it on that spreadsheet. But what you want to do is that when you take a trade, you want to be able to record that trade and say, okay, this is what I took. This is the time I took this trade. This is the date of the trade. This is the instrument I'm trading. This is what happened during the time I traded. Was it a winning trade? Was it a losing trade? All of that data that you are taking and imputing into your trading, what we call a trade journal. A trade journal, right? That data you are putting there is basically the data that will help you improve your trading tomorrow. That's the data that will help you improve your trading, improve your trading tomorrow. So you want to make sure you don't want to be flying blindly. You don't want to just see trades win or trades lose and you're random about it. No, you don't want to be random about it. You want to be systematic about it, okay? Strategic about it. So you will know why did there are trades you take, you'll be like, oh no, I shouldn't have entered this trade. So the parameters for this also should be in your trading plan. How am I going to record my trading? There are times where you set a trade, where you enter a trade and you know, I'm not supposed to have taken this. But how do you know you're not supposed to have taken it? Because another person is doing that same trade and is doing impulsively. There was a time someone would call me. It was someone that he was learning trading from me at the time. He would just call me, hey, this thing is buying. I've entered. As far as he's concerned, once he sees green candle, he just starts buying, you see? And then he will lose money and not know why he lost money and do the same thing again. That's what you want to avoid. So you don't want to be haphazard in your approach. So you want to be able to record it and say, okay, this is what I need to see to enter this trade. And if you break that rule, which you're most likely going to break once in a while, right? The goal is for you to now go back and caution yourself and say, oh no, this is a trade I shouldn't have taken. This is something I shouldn't have done. So next time you are reinforcing that information now by telling yourself, oh no, I shouldn't have done this. Yes, by the time you wrote it down, it was something that you wanted to stick by, right? You wanted to stick with it. But now that you are telling you made a mistake with it and you are trying to come back, now you're trying to correct yourself from the mistakes you just made, it reinforces it more. You may still make that mistake a few more times, but every time you make it, you reinforce. You tell yourself, no, I made a mistake again. The more you tell yourself, no, I'm not going to do this, I made a mistake, the more you get better. This is the important thing when it comes to measuring and reviewing. Okay, so this year, we're going to document our trades. We're going to document our trade. We're going to have a trading journal. Like I said, we're going to share something that will help you to do this. You can do it digitally with a spreadsheet on Google, or you can do it physically. I prefer you physically write it in a notebook. Oh, I took USD JPY at so and so time on so and so day. It played out well. I made 30 pips. Good. What happened then? Okay, everything played out well. Oh no, this trade should have giving me more profit if I had closed early, or if I had not closed early, or something. I saw a reversal signal happen. If I had taken my profit, I wouldn't have lost some of my profit. All of this is going to enter your trading journal. And it doesn't have to be complicated. We'll see when we get there. It doesn't have to be complicated. It's just something you are doing to help yourself come back tomorrow and look at that trade and say, okay, yes. Because every trade we take is supposed to teach us something. We're supposed to learn until we become unconsciously competent. We become unconsciously competent, where you can wake up and then you're able to do all the things you want to do in the market, right? Okay, determine your time horizon. Okay, all of this should be in your trading plan. What am I trading? Am I long-term trading? Am I a long-term trader? Am I somebody who will enter a trade and the trade is running for 1 week? I know a trader, this guy places a trade and the trade is running 2 weeks, 3 weeks, 4 weeks, 1 month, more than that. And as far as he's concerned, that's the best way to trade. That's the way he trades. And as far as he's concerned, that's the best way to trade. I personally am not that kind of a trader. Okay, I want to be able to enter a trade and do intraday trading is what I do, right? There are many people that do intraday. There are people who do scalping. They want to take 10 pips and they are gone. 10 pips of the market, 5 pips and they are gone. So you have to know which one is my personality, which is best for me. Which one do I like? I don't like to take 5 pips. I don't like to take 10 pips, right? But of course, I don't want to sit down and be waiting for my trade to go to 100, 200 pips. That's not what I want to do. I want to do 30 pips. I can do 30 pips and I'm good. I can do 50 pips, I'm good, right? So which one are you? Are you the one that wants to take 10 pips and you are out of the market, 5 pips? Are you the one that wants to take 30 pips and you are good, 50 pips and you are good? Or are you the one that wants 200 pips? Otherwise, you're not taking that trade. You don't care. If market goes up and down, it must get to 200 or 300 pips. And then, are you the guy who wants your trade to be running for the next 2 weeks, 3 weeks? The thing is going up and down, you know? So that's very important. You want to determine that. You want to have that also in your trading plan, okay? This will impact your choice of trading strategy and exactly. So this is going to determine how are you going to, what are you going to be using to trade when you determine the kind of trader that you are, okay? That should also be in your trading plan. So on this call, guys, I'm talking to traders. This year, yes, we are going to use the signals, but we are going to grow ourselves to become traders. Because if you want to make that $10,000, you want to make $5,000, you want to withdraw thousands of dollars every month, most of the time you discover that you can use signals, but signals may not get you to that point, to that income level. So you want to become good, you want to become skilled in this trading so that you can pull profits from the market at any time. Okay, you can pull profits from the market at any time, and basically you can trade anything. You can pick a new asset today, study it, and start trading it and making profit from it. You see, there are people who on our platforms, on Vantage platform, they trade stocks and they make a lot of money doing it. But the reason why they can do is because they've studied it. Some trade only gold, some trade different things, whatever it is, but basically you have understood how it works, and you know how to trade already. You learned a lot of all these things we're talking about, and then you're now applying it to a particular instrument to be able to win, so consistently take profits in the market from trading that particular instrument. All right. So that's going to be the goal for us this year, ultimately, to become that trader who can sit down on his laptop, on his phone, and see a market and see a trade and analyze it and pick that trade and profit from it. You see? So consider your risk to reward ratio. Okay, this is what I was talking about earlier. This is the ratio of the potential profit you could make on a trade compared to the potential loss. Okay, aim for a risk to reward ratio of at least 1 to 2, which means that for every risk of $1 you're willing to take, you are aiming for a minimum profit of $2. That's what I explained earlier. So if you have $1,000 in your account and you are saying, okay, I want to risk 3%. 3% of $1,000 is $30. Excuse me. 3% of $1,000 is $30, right? So my potential profit, according to this description, is to at least have 1 to 2 risk to reward ratio, which means that if I'm targeting, if I set a stop loss that will take my stop loss of like 30 pips, that means my take profit should be 60 pips. If I set a stop loss of 30 pips, which is my risk, my take profit should be at least double of that if I'm doing 1 to 2. Okay, so you can do 1 to 1 or you can do 1 to 2, depending on the personality you are. If you are someone who wants to quickly get out of the market, you might want to do 1 to 1. You know, but 1 to 2 is great. You might be flexible with it and say, okay, 1 to 1 sometimes, 1 to 2 sometimes. And it also depends on analysis. If you see that price is going to move much further down where you are anticipating, you may want to do even more than 1 to 1 or 1 to 2, right? But averagely, you can do 1 to 1, 1 to 2. If you are risking $30, you want to make 60. If you are risking $50, you want to make 100, right? So this is what risk to reward ratio is all about. And that's very important. This is very key when it comes to profitability. You have to manage. When you trade with risk to reward, you do not fret about the market. First of all, what this risk to reward ratio does for you is this. It helps you to define your risk very clearly. And then not only define your risk, it helps you to accept the risk. Because there are times where you can determine the risk. There are people who will set stop loss. By the time they see price is going there, they will delete the stop loss and increase it. Because they have not really accepted that stop loss, that risk. They didn't accept it. Because you need to not only define your risk, you need to also accept that risk. And know that, oh, this stop loss I put here, price can actually hit it and I will lose this money. It doesn't matter because you've already determined that I know how much I'm risking on my account. So it doesn't matter what that risk is all about. What matters to me is that I know from my strategy, I may lose a few times, but I know that if I enter one trade and I lose $30, and I'm using a 1 to 2 risk reward ratio. If I enter one trade and the trade didn't go well and I lost $30, which is 3%, and I enter the next trade and I make $60, what have I done? I've not only recovered my previous loss, I've made a profit of $30. That is how to trade. That's the reason why I said earlier that you can have a 50% win rate in your trading, which means that if you take 10 trades, 50%, 5 of them lose, 5 of them win, and yet you're in massive profit. This is how to do it. Risk reward ratio, understanding and utilizing risk reward ratios properly is how you win in the market. It's definitely how you win in the market. So even if there are times where your win rate can even be less than 50%, which means that let's say you take 10 trades and you lose 6 of them and win 4, yet you are in profit. You are still in profit. The way to do it is risk reward ratio. This risk reward ratio, when done properly, it can be the game changer in your trading and help you stay profitable even when you lose several times. But when you win, it covers your losses and then gives you extra profit, right? So of course, definitely as you're improving your trading, you're also using risk reward ratio, you see your profitability just goes through the roof. Okay? Choose your currency pairs. That's another thing that should be your trading plan. What's my currency pair? What am I trading? I was saying earlier that there was a currency pair I trade where I noticed some things changed. How did I notice it? Because I was following it. Some people trade only GBP USD. Some people trade USD JPY. Some people trade only gold. Some people trade only NASDAQ 100. Some trade only US 30. You have to pick. Some trade only Bitcoin. Pick which one am I going to concentrate on? Which ones am I best at? This, when you are doing this, you want to start with one. You want to start with one or two. The truth is that one trade, one asset in the market is enough to make you enough profit. That's just a fact. Whatever you think, whatever anybody has told you doesn't matter. Just know trading one asset alone is enough to make you enough money in the market. That's the fact. Okay. Consider factors such as liquidity, volatility, knowledge of the economy and all that. What that asset you're trading, you need to be able to follow it, because you can't trade so many different things. You can't say I trade 25 different pairs. How are you going to follow the fundamental events that are happening with 25 pairs? How are you going to follow them? Okay, something happened here, something happened here, something happened here that is moving the price. You don't know that something has changed. You are still buying when you should stop, when you should be selling. Because you can't follow all these things at the same time. That's the reason you don't want to trade too many pairs. You want to trade only a handful, very small number, so that you can follow what's going on with those assets to stay consistently profitable. Develop a consistent approach. It's important to be consistent in your approach to trading. This means sticking to your trading plan and not letting your emotions influence your trading. So what this means is very, in simple terms, is this. If you decide that you use a strategy that requires you to see, let's even say it's an indicator-based strategy. I'm using what's it now? RSI and stochastic. Whenever the RSI crosses, I make a buy. Whenever it crosses, I make a sell or something like that. We're not discussing that here right now. I'm just using that as an example. You have to make sure that you're disciplined enough to wait for the signals. The signal that your trading strategy is going to give you, you have to be disciplined to wait for it at every time. Don't jump in and say, okay, I know this thing will cross. It has not crossed, but you are thinking, it will cross, it will cross. Let me just enter. Let me enter now before it crosses. And then you don't know that something is about to happen. Something different is about to happen in the market. And then the thing doesn't cross and it reverses. You're like, oh, if I had waited for it to cross. If you had waited for it to cross, you would have missed that bad trade. So that's what it means to have consistent approach. Determine clearly in your trading plan what you need to do, what you are going to see before you enter a trade. And wait for it at every time for it to happen before you enter that trade. Because one major thing we do in trading is that we aim for consistency, we aim for discipline. We are developing discipline in ourselves when we are trading, when we're learning to trade, and when we are trading, we're developing discipline in ourselves. So following a consistent approach helps us build that discipline muscle. All right, it helps us build that discipline muscle. If you wake up every day by 5 a.m., within 1 month or 1 to 2 months, you become a master of that. You don't have to, sometimes you don't have to struggle anymore. But imagine that you wake up 5 a.m. today, you wake up 7 the other day, you wake up 4 the next day. Your mind doesn't understand what you're trying to do. If you say you have a goal to wake up at a particular period of time, and now you are confusing your mind by waking up at different times, what happens? You're not able to build discipline. Okay, but if you do it the same time on every day, at the same time, very soon you become a master at it. Okay. Stay up to date on the market. All this is very important too. When I wake up in the morning, do I go to Forex Factory? Do I go to investing.com? Let me see what news is happening with dollar today. What news is happening with euro today? What news is happening with pound today? What news is going to move gold today? All of that is very important because as it relates to the instrument that you trade. What is it that you trade? Okay, so this is going to be specific to the instrument that you're trading. Not you can't like, that's what we said earlier. You can't go over everything. There's no way you can have your fingers on every single thing in the market. No, that's the reason we want to pick only a small number of instruments that you're trading, so that every morning you have it in your plan that, okay, this is where I'm going to go. I'm going to check this, check Forex Factory, check investing.com, check this, check that, and know what is strong, what is happening, what is it that's happening in the market today, what's happening now, what's going to happen 2 p.m., what's going to happen 3 p.m., what major news event is going to move this asset later today. So I need to be prepared so that you don't wake up and be trading, and at that time something happens and your trade that was in positive becomes negative. Because that happens all the time. Okay, so you want to also put that in your plan. The places where you're going to go every morning to find out what events are going to move the market for the day, and then you keep tabs on it. And something you could do is you can look at the news events that are going to come out in a day and set alarm, maybe 5 or 10 minutes to that time, so that you can look into the market and see if I have a trade that is running and the trade is running positive and there's a major news coming out, I better close that trade and wait on the sidelines, so your alarm goes off, then you go to your market again, you check, okay, am I in profit? What's the state of this trade? Should I close it now? Because there's a news coming. Because a news event, we all know, can change the direction of the market. You can be in positive and it's going, and then something just happens and the market reverses. So you want to be able to be on tab with what's going on in the market so that you can make decisions just before the news comes out. So a way you could do that is set an alarm 10 minutes to the time when a major news is about to be released, and then you can then manage your trade like that. If your trade is in good profit, you can break even or take your trades into positive, what we call stop profits. You put it in profit and then you let the trade run. Whatever happens that time, the worst case scenario is you are going to be profitable on that trade. You are not going to lose any money on that trade. Okay, let's keep tab on the markets, right? So take breaks. This is also very important. This has to do with psychology. Okay, so you made money, you traded in the market, you closed your trades, and then you want to be able to stay away from the market. Oh, I made this amount of money. Oh, there's a setup still coming. No, let me stay away from the market and rest. Because the truth is this: the more you look into the market, the more you stay in the market, the more it affects your judgment. The more it affects your judgment is not optimal 100% of the time in the market. Your judgment is not optimal 100% of the time in the market. Okay, so if you just wake up in the morning, you enter the market, you are fresh. But as time goes on, as the day goes by, as a lot of other activities are happening, you've taken trades, you are doing other things, all of that put together, before you know it, you discover your decision making is not as sharp as it was in the morning when you just got up. Okay, so this is the reason why you want to mentally relax. Trading can be mentally exhausting, so it's important to take breaks and avoid over trading. Set aside regular breaks to give your mind a rest and come back to your trades with a fresh perspective. Okay, that's very, very important. Also, we need to put this into our trading plan so that we can know that, okay, I need to rest at so and so time. I need to rest after 2 trades. I need to rest after 3 trades. That's sort of a thing. Okay. All right. So now we're going to ask some questions, but before we do, there's a spreadsheet I will go to so I can show us what I was talking about earlier. Okay. This spreadsheet it was supposed to be possible to make a copy of it. Okay. This spreadsheet was done by somebody, and I saw it and I decided that we can get quite some benefit from it. That's why I picked it. Okay. Now, normally we're supposed to be able to make a copy of it, but I think probably those that programmed it, they removed that feature. Okay, they removed that feature. You're supposed to be able to make a copy so that you can use it for yourself directly. But the only way we're going to use this now is just to use it as a template. Okay, you can make your own. Most of what we're going to what I'm going to show you here, they are not necessarily something that you need to do on a spreadsheet. You don't need to do them on a spreadsheet. You can do them on a notebook. I personally prefer to do journaling on a notebook. Okay, there's that thing about you writing it by yourself. You will hear that also from some top traders that they journal they do their journaling, which means recording their trades. That's what we call journaling. recording their trade, they do it manually. So it's recommended, if you can do it manually, it's a good thing. Okay, so we'll just look through a few things here. So look at this now. So like I said, I'll share this screen, I'll share this spreadsheet after this class so that you can also open it yourself on your phone or your laptop. Then you'll be able to use it just as a cue to understand what we're talking about. So test pairs. So these are the pairs this person is working with for the year. Okay, so you pick your own pairs and say, you see the person picked 4 pairs. Good, GBP, JPY, USD, US 30, NAS 100. Those are the pairs the person is working with. Now you can have more than that, but it's recommended that you have few. Between 1 and 4 is good. Between 1 and 4 is excellent, right? So the smaller the better, if you ask me. So enter up to 8 different pairs. Well, you don't have to enter that. You don't have to do more than a few. Okay, so these are the sessions traded. Okay, so am I trading session? Am I trading Asian session? For there's a particular asset I trade. I don't usually like trading it at night. I don't usually like trading, so I would like to exit my trade before night. So I trade during the day. Once it's 6 p.m., once it's like 5 something-ish, 6 6-ish, like that, I notice that the market starts to slow down for that particular asset that I trade, instrument that I trade. So I would not be looking to enter the market while I go to sleep. So that's something that I do for that particular instrument that I trade. So you need to also pick that for yourself and say, okay, this is when I trade this. I will trade the Asian session. Asian session is start from 10 p.m. Nigerian time till morning. Okay, Asian session starts. No, Asian session is not from 10 p.m. That's it's a Sydney session that starts by 10 p.m. Asian session usually starts somewhere around 1 a.m. Nigerian time. Okay. Now, of course, if you're in South Africa, that should be like 2 a.m. South African time. Okay. So maybe you trade London session. Or when London opens usually 8 a.m. Nigerian time, 8 or so. Yeah. Okay. I think because of daylight savings now, you know, daylight savings is when their time goes behind by 1 hour. Okay. So I think there's daylight savings at this time. It usually ends around March of this year. It will end around March this year. So we are about 1 hour ahead of them right now. Okay. So after this period, the time comes back again, we'll be at the same. Nigeria and London is what I mean. Will be at the same time. Okay. So New York session, you want to trade the New York session, you want to trade the Asian session, all of that you determine them. Okay. So now it comes to time frame. What time frames am I trading off of? Let me use another example again. I have a particular instrument I trade it only off of the 1 hour charts. I can look at 4-hour charts sometimes, but I mainly trade that asset off the 1 hour charts. Of my analysis is mostly 1 hour, my trading is 1 hour. It has to play out. What I want to trade needs to play out on the 1 hour chart for me to take it. If it doesn't play out on 1 hour chart, it is likely going to be wrong. This is from my own personal experience. So this is the reason why you want to pick. There are people that trade off of 5 minutes, and some trade out off of 1 minute. Okay, it depends on your particular. Remember, this class is about traders. We want to become the best traders we can be this year. Okay, so you want to be able to know, what am I trading? What time frame am I trading it on? Am I trading 5 minutes, 10 minutes, 15? Am I doing multiple time frame analysis? That's one of the trainings we're going to do later on too. We're going to have a schedule for all our trainings. Multiple time frame. Maybe you are doing analysis on the 4 hour and you decide that, okay, I'm going to do 4 hour, I'm going to do 1 hour, then I'm going to take my entries on the 15 minutes. That's multiple time frame analysis. Sometimes you can do, depending on what you are trading. If you are a long-term trader, where you are taking a trade that's running for 1 week, you can start your analysis from the monthly chart to the weekly chart to the daily chart. But of course, if you are a scalper or you are an intraday trader, you may not need to go to the monthly chart and weekly chart. You may just do your analysis on the 4 hour, you trade on the 15 minutes or on the 30 minutes, and you are good. Okay, all of that needs to be on the plan. So you don't come into the market today, you trade off of 1 hour, then you come tomorrow, you trade off of 15 minutes. You will discover your results will not be consistent. your results will not be consistent. And that's not what you want to achieve. Consistency is how you grow your accounts. Consistency is how you build your account and grow your account, right? Okay, so entry types, setup types, breakout, fake out, onion, week special. All of these are strategies. Some of them we're going to be teaching them during our trainings. All of these are different strategies. So this person now is saying, okay, these are the 4 strategies I'm using to trade. Okay, so what strategy are you using to trade? You define it and put it there as well. All of this should be on the trading plan. Okay, even if now at this time you may be like, oh, well, I don't have all these things in place. Shouldn't I have a trading plan? You should still have a trading plan, even though you don't have all this in place. Whatever it is you have, if where you are right now is that you take signals to trade, still put it there. If you have your own strategy for trading, put it there. These are the things you should define, especially if you have your own strategy for trading. This is how you should define it. Make it bold and clear. This is information that is for you. It's like your business plan. So if you are doing a business plan, you don't leave things out of it and say, okay, that's not important. Then no. You put everything there. Okay, because it's your business plan. Everything there is very important towards your business. Business is not joke, right? It's war, it's serious business, right? Business is serious business, okay? So now, since business is serious business, you want to make sure every detail you need is there. Trading is serious business too. You want to make sure every detail that you need is there. Okay, what am I trading? Entry types, flip, break previous high and low, break current high and low, calorie. All of these are entry types. Okay, entry types. How do I enter? Do I need to break out the structure? Once it breaks a structure, it retests before I enter. Do I need to use Fibonacci retracement, 50% retracement, 61% retracement? That's where I enter my trade. All of these are entries as well. What exactly am I doing? You have to define it clearly. Right, guys? So this is it. Then time frame, like I said, I talked about time frame already. Okay, we pick that time frame. So let's go somewhere. Playbook tester. So this is where you want to be able to define for yourself, what am I going to see? This is like visually, this is like visually defining for yourself what your entry should look like. What's my entry going to look like? Okay, where am I going to enter? Look at this now. Buy stop. You enter there. Okay, this is where I put my stop loss. This is where I enter. This is where my stop loss should be. So this particular page, guys, playbook poster is very, very important when it comes to understanding where your stop loss should be when you enter trades. When I enter a trade, where should my stop loss be? Make sure you look at this, guys. Like I said, I'm going to share it. So this will help you to understand when you enter a trade, when you enter a kind of setup, where is my stop loss going to be? I hear that question a lot. You know, we tell you, okay, it should be on the other structure. It should be, you know, the previous high, the previous low. This will help you to understand that very clearly. And then also you see the different kinds of entries and all that. You have small wick down, you have steeper wick down, you have calorie play, you have small wick down, you have steeper wick down, all of that. You see? All of that. Will you share it? Yeah, of course, I will share it. I will share it. Definitely, I'll share it. After this class, I'll share it in the group so that you guys can have it. So you can see all of that. You have onion play, onions, you have onion play wick, a small wick, onion play steeper wick, onion plus calorie. So all of these are setups that you will see in the markets. You see, all of these are, yes, you're welcome. So all of these are setups that you will see in the market, and then you'll be able to know how to enter it, where your stop loss should be, and all of that. You see, so all of this can be, you can define them and put it in your trading plan and say, okay, this is what I want to see. This is when I see this, I'll be able to trade. I'll be able to enter like this. Then I'll use my stop, I'll set my stop loss like this. Okay, so you can see now that when you set your stop loss like this, from here to here, the entry, you've already hit 1 to 2, 1 to 2 risk reward ratio. You know, if it's 1 to 1, you set, you've already hit your take profit. So you see that your trades start panning out clearly. You see that you have less of your trades losing and more of your trades winning. And that's the way, that's the remedy, that is the formula for growing your account. Your account just keeps growing like that, you know. So you find out that your losing trades are fewer, your winning trades are more, you know, just keeps going on like that. Just keeps going on like that. Okay, so now you can look at all the tabs. When I share it, look at all the tabs. But let's go to January. So, because there's something I want us to see here. So look at this. You see, this is how you journal your trade. When we say journaling, this is how you journal your trade. This is a template that will help you journal. You can just take this and use a notebook on your own and put it down on a notebook with the headings. Okay, dates, you have time, you have session. Session has to do with, were you trading Asian session or London session or New York session? So what exactly are you trading? You define that. What pair am I trading? Okay, I'm trading USD JPY, or I'm trading Euro USD. You put it there. Did I buy or did I sell? Excuse me. Would I buy or did I sell? You put it there as well. Setup type. What is my setup type? Okay, was it breakout, retest? Some of those setups we're seeing just now, right? Onion and all that. Now, even if, what I'll tell you is this, guys, don't focus on the name. The name can confuse you. What you need to do is focus on recognizing the patterns, recognizing where you need to take your trade. That's the most important thing, not the name. So don't try to memorize the name and all that. Forget about the name. The name, of course, if you remember it, fine. But the name is not what's going to pay you. Recognizing the pattern and being able to trade that pattern is the goal. Okay, guys, that's very important. So that's setup type. Entry type. How did I enter? All of these we're showing just now. Playbook, all of these are entry types. Entries, you say bullish price action setup and entries, bearish price action setup and entries. Okay, so those are the entry types that we're talking about. So do not bother so much about the name that is called, like I said before. Don't bother so much about the name. What's more important is you are understanding what's going on. And then what we're going to do is that some of these setups too, we will explain how their formation. In later classes, we will do a lot of explanation of several of these setups as well, so that you can understand what plays out here, what's playing out here in all of these setups right now. But of course, at this time, you just take it, understand it, use it to look at the market yourself. Later on, we're going to explain them in more details. Okay. So that's entry type. Then time frame used. Okay, did I trade on 15 minutes? Did I trade on 1 hour? Did I trade on 30 minutes? You define that. Correct idea. Okay, was this idea, what came out of it? Was it a positive result? Did he win? Did I lose? Did he hit my stop loss? Did he hit my take profit? You define that there. And also explain a little bit of what happened. Did you execute this trade properly? That should be part of what you add there. Did I execute this trade properly? Is there something I could have done better? Is there something I will do better next time? Just indicate there, because that will help you remember. Because if you come back 1 month later and you want to look at your journal and you see, you want to remember exactly how it happened that day, you will not remember. But if you write down something, when you come there, you remember, oh yes, this thing that day, this thing, oh, I should have done this, I should have done. Okay, now you are reinforcing your learning that way, right? So now you see all of this is just basically more and more data, more data, gold, depending on what you're trading, the stats, all the trades, and the session, all of this is just more data there. So take your time, look at all this and just benefit from it. So let me share this right now. The group. Okay, so that's it. That's it right now. I shared it in the group. So do we have any questions? That's where we are now.